Tom Lee just dropped a bombshell on CNBC, and I think this is something that you need to hear because odds are you're invested in just the areas of the markets that would benefit if Tom Lee is correct. Now, who is Tom Lee? For anyone that does not know, he was the guy that was arguably a little bit too bullish on markets in 2022. He was very bullish on especially Magnificent Seven and AI stocks like Nvidia heading into 2023 when everyone was negative. It was value, it was oil at the time that everyone wanted to own. But guess what? Tom Lee turned out to be spot on. And really nobody could even hold a candle to the returns that Tom Lee's seen. So when he speaks, I think it's something worth taking note of. So I'll run the clip and then we'll talk about it.
Who might be right? Let's talk about it with another guy who's pretty successful in his own right. That is Tom Lee. He is the managing partner and head of research at Fundstrat. If you had to go on Team Cohen, which I guess is the Mets, and Team Einhorn, like I'll call that the Brewers because he's from Milwaukee, which team would you be on, Tom Lee?
Well, I hope I don't get judged, but I'd be on the Team Mets and Cohen.
Why is that? Lay it out.
Well, I think that the reason the idea of cuts was being rolled back was the January and February inflation reports globally showed inflation was accelerating. And part of that is a statistical aberration. There's just some really poor seasonal adjustments that take place. The March CPI reports coming out of Europe have shown a big collapse from those January, February levels. Like Eurozone, it's back to 2.4%. The March CPI for the US is coming out next week, which is April 10th. And by the time the Fed meets in June, there's going to be a total of 3 inflation reports, March, April, May. I think by then, markets are going to be a lot more confident that inflation is falling and the 3 cuts actually may be too low. There's a possibility there's more than 3 cuts this year.
Okay. Wow. I tweeted out a poll yesterday, and I think we might get less or maybe none, but that's why you do what you do, and I sit here on this side of the camera, Tom. If we get 1 cut, if we get 2 cuts, if we get 3 cuts, if we get 4 cuts, does that change your end-of-year S&P target? I mean, does another 0.5 percentage point off the Fed funds rate matter to the S&P 500 in the short term?
Brian, I think the number of cuts won't matter as much as the reason the Fed is titrating its cuts. If the Fed is titrating its cuts because the economy is showing resilience, so it's strong, but not necessarily inflationary, I think the market would take that as quite dovish because it's really a Fed trying to manage the business cycle. If the Fed is cutting back its number of cuts because inflation is reaccelerating, that would actually be incrementally bearish. So I think that the rationale actually is more important than the number of cuts.
Okay, well said. Tom, I want to switch gears a bit. The Federal Reserve, we've been focused on inflation for 3 years, but the Federal Reserve's dual mandate also looks at job growth. And a new article today in the Wall Street Journal highlights a rather curious trend in the difference between the 2 ways that the federal government measures employment. And if you read between the lines in the journal's article, it implies that much of our recent job growth, maybe a majority of it, is due to immigration. Much of that, of course, would be undocumented immigration and those seeking asylum. In fact, the CBO, Tom, just raised population growth estimates to account for the millions who've crossed the border in the last few years, leaving out all political arguments about the border. We're talking about the markets here. Do we care? And Morgan Stanley alluded to the same issue kind of yesterday. Do we care where the job growth really comes from when we're looking at markets and the Fed?
Brian, it's objectively, it's actually a good thing because we know the Phillips curve's kind of been busted. That's supposed to measure unemployment rates and wage inflation, and we've had unemployment sort of pinned at these levels and wage inflation isn't accelerating. So it shows that we're adding jobs, we're adding to the worker supply and actually adding to aggregate demand without creating inflation. And on balance, that's quite positive. And does it matter where this labor supply is being filled? It's a great question. But as you know, I mean, the U.S. is essentially a nation of immigrants anyway. So I don't think necessarily immigrant labor driving wage growth and demand growth and filling jobs is a bad thing.
So Tom Lee had two very important points to make: that inflation is starting to fall for data that we are getting for the month of March. And that's actually correct from the data that we have seen recently, even yesterday with ISM services prices. That came in a lot lower than estimates. The estimate yesterday was 58.4. The number came in at 53.4. You came in 5 points lower than the estimate for ISM services prices. That has not happened in a very long time. If you actually take a look at service prices here, this is the lowest you have seen in over the last year. I mean, you have to take this back to I believe, yeah, this is the lowest you have seen since the inflation bout started back in April of 2020, right? You actually have to go back to before then. You have to go back to February of 2020 to get an ISM services prices number this low. And I mean, this pretty much correlates exactly to what you see with inflation. Just take a look. Right? August, September, prices paid was about 58.9. What happened? You fell over the next coming months. You hit a low in December of 2023. You've seen a lot of progress on inflation during this moment in time, right? And then you kind of seen the spike for January. It was still elevated for February, and now you're back down to even lower levels. This means the CPI report coming out in March is probably going to look pretty dang good. Now, there are a lot of other different charts and things you could look at to show that you're continuing to see this disinflation in March. Maybe January and February were just a bump after all, as Fed Jerome Powell has suggested they could be. And if we get back to seeing progress on inflation coming in the next inflation report next week, as Tom Lee said, you may need to price in more rate cuts. Because remember the argument in 2022? It was, wow, inflation is 7, 8, 9%. We're going to have to get the federal funds rate above that to get inflation down. That's what you had to do in the 70s and the 80s, the last time we really seen super high inflation. Well, now where are we at? If you're looking at inflation on a year-over-year basis and core PCE specifically, you're at 2.8%. The federal funds rate's at 5.5%. That means on paper, you are very restrictive. And I guess that's a double-edged sword, because you are very restrictive in the areas of the markets, the economy, that the Fed actually has an influence on, like lending, autos, homes, right? There's not a lot of activity in these areas, financing anything. Just not a lot of activity there because the Fed has created such a restrictive environment. For services, for housing, there's not a lot you can do, and there's millions of people coming into the country, and they all need houses, right? Good luck trying to get housing inflation down in that market environment. And you could actually make the argument that if the Fed starts to cut rates, maybe that could have a positive effect on housing inflation, right? If you're a landlord, you're not going to be able to charge cheaper rent. If you can go out and refinance that home, at least a little bit, maybe you can afford to not raise prices again, because that could make your net margin larger. But the point is, the Fed has done their job in the areas of the economy that they can affect. There's just some areas that they can't affect, and those some areas like services, you're starting to see that disinflation there as well, at least what we've seen with the data yesterday, and that could support the Fed even cutting rates more than 3 times. But let's be honest, a lot of people in the markets, they're not expecting 3 cuts from the Fed. They're expecting like 1, maybe 2 cuts. So if Tom Lee is correct, and maybe we get more than 3 rate cuts, you're going to find an interesting dynamic that starts to play out in our markets. The S&P, the NASDAQ on the headline, they are fully valued. They are expensive by most people's metrics, trading at 21 times next year's earnings. That is, of course, if earnings come in line with estimates. If the estimates are not too high, or, well, if earnings come in higher, then maybe the markets are a little bit cheaper today. That's the beautiful thing about investing. You can go with whatever you want to go with, right? If you think earnings are going to be higher next year than 11% EPS growth for the S&P this year and next year, if you think it's going to be like 12% this year, 15% next year, then maybe you want to be buying the broader S&P and the NASDAQ. I don't like those odds, though. I think that's pricing in a lot of good news. What you will find happening if we get more rate cuts than what the markets are currently expecting, again, most investors are expecting like 1 to 2. So even 3 rate cuts would be on the higher end. If you're talking 4 or 5, maybe 50 basis point rate cuts at some point as we get closer to the election, what you're going to see is a broadening out of our markets. You're going to likely see some kind of profit taking in your Magnificent Seven stocks. And maybe money coming off the sidelines from money market funds. Keep in mind, there's over $6 trillion in money market funds right now. That is 3 times the market cap value of NVIDIA. That is over 3 times the market cap value of all of the Russell 2000. So you could see a lot of money come back into our markets, and it likely goes into the areas that will benefit from more rate cuts from the Fed. Your small caps, your interest rate sensitive names, your economically sensitive names. Those would be the stocks that get a lot of the inflows. Think PayPal, think Tesla, think SoFi, think, all these stocks that you guys may be invested in that even to some degree are consumer related, like a Nike's. They could start to benefit from rates going lower also, which odds are those are probably the names that you are most invested in that could benefit the most from what Tom Lee is talking about here. And I don't think he's all too wrong at this point. Now, there's a chance that inflation does kind of just remain sticky here or even go up a little bit. But what we're seeing with some of the data for the month of March is kind of showing that January and February may have just been a bump in the road. And if you take a look at the percent of stocks above their 50-day moving average, you're currently at about 59.5%. So 59.5% of stocks are above their 50-day moving average. Do you remember, hopefully you remember, the rally you've seen from November to the end of December, specifically on December 28th? You went from 15% of stocks above their 50-day moving average. So basically everything was in a drawdown at that point. From this period here from July through November, that was a 10.5% correction in the S&P. Well, you've seen this huge rally. You got up to a high of 86% of stocks above their 50-day moving average. This was really a broad-based rally. Small cap stocks, interest rate sensitive stocks, big tech, everything was rallying. Well, right now, the markets are still sitting close to all-time highs, but the average stock has actually been declining as you went from pricing in 7 rate cuts in 2024 at this moment in time, where my cursor is towards late December, and now you're only at 3. Well, if those expectations start to move up again for more rate cuts in 2024 or more rate cuts in 2025, as you know, markets are a forward-looking instrument. They reward forward earnings and expectations going higher, not backwards. Nobody cares about what happened last year or last quarter or yesterday, for that matter. It's all about the future. So if that scenario starts to play out, which I think is a pretty good likelihood at this point, then you'll probably start to see the average stock outperform. But like Tom Lee said, it's going to be important to why the Fed is cutting rates. If the economy is weakening at the same time inflation is falling, that may not be good. You want to see the economy kind of just trade sideways. I say trade, but like trend sideways. You don't want to see big rises in the unemployment rate. You don't want to see your jobs reports come in bad. You don't want to see your services, manufacturing indexes start to come in bad either. Good news is on Tuesday, we had ISM manufacturing PMIs that came in higher than expected. So it looks like manufacturing has now went positive for the first time since late 2022. So that's positive. If manufacturing comes back in the economy, that could help offset some other areas that may not be doing as well. Maybe a little bit of weakness in the economy and more cuts from the Fed would be positive for equities, but really it's all about recession fears. Think about what happened in 2022. You had this huge drawdown in the NASDAQ, a huge drawdown in the S&P, but why did this actually happen? Earnings were still coming in just fine at this moment in time. You had a 37% drawdown from, early 2022 until about October of 2022. This happened because of fears of a recession. So if you get fears of a recession that come into our markets, if the economy does slow down even further, then that's where things will start to take a turn for the worst for the broader markets. But as long as things kind of just continue to chug along, in which they have been up until this point, then I think you really get a good market coming late this year into next year. And again, this is really going to affect the areas of the market that you are probably mostly invested in. I'm going to go out on a limb and say most of you guys are not heavy in index funds or heavy in Magnificent Seven stocks. You may own some of those, but I think a lot of you guys are probably in PayPal, SoFi, Palantir, some of these stocks that will really benefit if Tom Lee is correct. And ultimately, if the economy just continues to chug along and inflation continues to fall. All eyes will be on the non-farm payroll report coming out tomorrow, as well as the unemployment rate. Your non-farm payrolls tomorrow are expected to come in around 200,000 job ads. I don't think the markets really get fearful over a recession until you come in like sub 100,000. Until you get close to seeing negative month-over-month numbers for the non-farm, payroll report, that's where the markets start to get a little bit more fearful. But 200,000, that's a very strong economy still. That's above just overall trend, which is crazy. I don't know how we keep putting up these numbers. But as well as that, the unemployment rate. The unemployment rate has recently ticked up to a new high that you have not seen in about 2 or 3 years, and you're sitting at 3.9% unemployment. If that goes up again, that's not going to be great, and definitely something to be watching for heading into tomorrow. This data will come out at 8:30 in the morning. Let me know what you think about this information down below in the comment section. Hit the like button and subscribe to the channel if you made it to the end of this video. You guys have a fantastic rest of your day, and I will see you in the next one.